Leverage really gets a bad name. I mean, this question is a very loaded question because, the typical answer is, well, we don't go above 65% LTV, or whatever. And that's just bullshit. Like we've levered up to, 75, 80, 85% because sometimes you have to look at it through two lenses. One is LTC, loan to cost ratio. Then there's LTV, loan to value ratio. So on a cost basis, we might have 80%, 85% leverage. But if I'm buying it for 50 cents on the dollar, I don't want to be penalized for using higher leverage on its face and not be able to get the type of returns that we're looking for. So on a multifamily project, we bought a lot of 1960s, 1970s vintage product that are on massive land sites that we can redevelop in the future. So we can go in and buy those for a little bit less equity, and from a multifamily standpoint, quote, have more leverage, at the beginning, but we know we can redevelop it and go hit a 30 IRR. I don't have a problem using the leverage as long as the value mechanism isn't out of balance. So that's the main point, because a lot of times we're buying things, at, very attractive costs. So as I said, on a loan to cost basis, it looks like the leverage could be high, but on a loan to value basis, you're at 30% leverage. So it's not a question that can be answered in a vacuum. It's on a deal by deal basis. But do we want to be over levered with super high octane debt? No.